Have you ever wondered why some of the biggest changes in the global economy seem to happen long before most people notice them? Financial headlines often focus on inflation, interest rates, stock market movements, or government policies. Yet beneath those daily stories, there is another force quietly shaping the future of markets, currencies, and wealth. It is a force that has influenced economic transitions for centuries, redirected investment across continents, and played a major role in determining which nations rise to financial prominence and which struggle to maintain it. What makes this force so important is that it often moves before the headlines appear. By the time a major economic story reaches the front page, large amounts of money may have already shifted from one asset class, region, or country to another. Understanding these movements can provide valuable insight into how investors, institutions, and governments respond to changing conditions around the world. When people discuss money and the economy, conversations often revolve around central banks, inflation, or interest rates. While these factors certainly matter, the broader financial system is much more complex. Modern economies operate through a combination of government spending, debt issuance, investment flows, banking activity, and public confidence. These elements constantly interact with one another, creating cycles that influence everything from employment and economic growth to asset prices and currency values. One of the most fascinating aspects of economic history is the ongoing debate about what gives money its value. Throughout history, societies have experimented with different monetary systems. Precious metals such as gold and silver have played significant roles for thousands of years. Their scarcity, durability, and widespread acceptance made them attractive as stores of value and mediums of exchange. However, many people assume that systems based on precious metals automatically create stability. History suggests the reality is more complicated. Even when gold and silver served as money, their relative values fluctuated dramatically. The ratio between gold and silver prices has moved through wide ranges over different periods. These changes remind us that markets are constantly adjusting to shifts in supply, demand, technology, trade, and economic conditions. This raises an important question. If precious metals have historically experienced large price swings, can any monetary system remain completely fixed over long periods of time? Economic history suggests that maintaining rigid financial structures can be difficult because economies themselves are constantly changing. New technologies emerge. Population growth alters demand. Trade patterns evolve. Natural resources are discovered. Productivity rises and falls. Political priorities shift. Every one of these developments influences economic activity. Consider what happens when the supply of a valuable commodity suddenly increases. Historical gold discoveries provide a useful example. When large amounts of gold entered circulation, its purchasing power could change because supply expanded more rapidly than before. This illustrates a simple but powerful principle. Even assets considered stable can experience significant changes in value when economic conditions evolve. The challenge becomes even greater when governments attempt to maintain fixed exchange relationships while broader economic forces continue moving. Economic cycles have always existed. Periods of expansion are often followed by slowdowns. Investment booms may eventually give way to corrections. Consumer confidence rises and falls. Because these cycles are natural features of economic activity, maintaining a completely fixed financial framework over long periods can prove difficult. This does not mean stability is impossible. Rather, it suggests that flexibility often becomes necessary as circumstances change. To understand modern financial systems, it is helpful to examine how money creation works today. Many people assume that central banks are responsible for creating most of the money in circulation. In reality, modern economies involve multiple sources of financial expansion. Government borrowing plays a significant role. When governments issue debt to finance spending, those obligations become integrated into the broader financial system. Investors purchase government securities, institutions hold them as assets, and financial markets incorporate them into lending and investment activities. Over time, this process can lead to substantial growth in total debt levels. As debt accumulates, interest payments become increasingly important. Governments must allocate resources not only toward current spending priorities, but also toward servicing existing obligations. This dynamic introduces a critical consideration. Debt does not simply represent money borrowed today. It also represents future commitments. The larger the debt burden becomes, the more important confidence becomes within the financial system. Confidence is one of the most powerful, yet least visible forces in economics. Markets function effectively when participants believe obligations will be honored, institutions will remain stable, and economic systems will continue operating predictably. When confidence remains strong, investment flows freely. When confidence weakens, capital often begins searching for alternatives. This brings us to one of the most important concepts in global finance. Capital flows describe the movement of money between different assets, sectors, and countries. Investors constantly evaluate opportunities and risks. As conditions change, capital may move from bonds into stocks, from stocks into commodities, from one currency into another, or from one country into another. These movements are not random. They reflect collective decisions made by millions of participants seeking opportunity, stability, or protection. Sometimes capital moves toward innovation and growth. New technologies can attract substantial investment when investors believe future returns will be attractive. At other times, money may flow toward defensive assets when uncertainty increases. The remarkable thing about capital flows is that they often reveal changing sentiment before it becomes obvious to the broader public. Imagine a situation where investors begin growing concerned about economic conditions in a particular region. Long before major headlines appear, capital may gradually start leaving that area. Investors might reduce exposure, diversify holdings, or seek opportunities elsewhere. These shifts can create early signals that underlying conditions are changing. This phenomenon has appeared repeatedly throughout history. Financial markets often react to expectations rather than current realities. Participants attempt to anticipate future developments, and their actions can provide clues about evolving risks and opportunities. Because of this, many analysts pay close attention to patterns of capital movement. Rather than focusing exclusively on individual news events, they study how money behaves across currencies, bonds, equities, commodities, and real estate. When viewed collectively, these movements can sometimes paint a broader picture of global economic sentiment. History offers numerous examples of capital flows influencing economic outcomes. During periods of instability, investors have frequently shifted assets toward regions perceived as safer or more stable. During periods of strong growth, capital has often flowed toward emerging opportunities. These trends have helped shape the development of nations and financial centers over time. One particularly significant historical lesson involves the relationship between global conflict and economic transformation. While conflicts create enormous human and economic costs, they have also influenced the movement of capital, production, and investment throughout history. Major geopolitical disruptions can alter trade routes, industrial capacity, technological development, and financial leadership. As investors reassess risks and opportunities, capital often relocates accordingly. In some cases, countries experiencing relative stability have attracted substantial inflows during periods when other regions face significant challenges. These inflows can support industrial growth, financial development, and increased economic influence. Over time, such shifts can contribute to changes in global economic leadership. Another important factor is the evolution of financial institutions themselves. Many modern institutions were originally created to address specific economic challenges. Financial systems often develop in response to crises, inefficiencies, or changing economic needs. What begins as a solution for one era may gradually evolve into something very different as circumstances change. The structure of financial systems reflects decades of adaptation. Policies are modified. Regulations are updated. Institutions gain new responsibilities. Markets become increasingly interconnected. As a result, understanding today's economy requires more than examining a single institution or policy. The modern financial system functions as a vast network of interconnected participants whose decisions collectively shape outcomes. This complexity explains why simple explanations rarely capture the full picture. For example, Blaming a single institution for all economic challenges often overlooks broader structural factors. Debt levels, demographic trends, productivity growth, fiscal policy, technological innovation, investor psychology, and international capital flows all influence economic performance. Focusing on only one variable risks missing the larger context. One area receiving growing attention today is the long-term sustainability of government debt. As borrowing increases over decades, interest costs can become more significant. Higher interest expenses may influence future budget decisions and policy choices. This does not necessarily imply an immediate crisis. Many advanced economies have managed substantial debt burdens for extended periods. However, rising obligations increase the importance of maintaining investor confidence. Investors continually assess whether governments possess the economic capacity, institutional strength, and policy flexibility necessary to manage long-term commitments. When confidence remains high, financing conditions may remain relatively stable. When confidence weakens, borrowing costs can rise and financial pressures may intensify. This relationship between debt and confidence helps explain why financial markets pay close attention to fiscal developments. Another key insight involves the role of diversification. Throughout history, investors have used different assets for different purposes. Stocks offer participation in economic growth. Bonds provide income and relative stability. Real estate offers tangible value and potential cash flow. Commodities can respond differently to inflationary pressures and supply constraints. Precious metals occupy a unique position within this framework. Many investors view them as alternative stores of value during periods of uncertainty. Their appeal often increases when concerns emerge regarding inflation, currency, stability, or financial risk. However, it is important to remember that precious metals are influenced by numerous factors. They do not move solely because of inflation. Interest rates, currency trends, investor sentiment, industrial demand, and global uncertainty can all influence prices. This complexity reinforces the importance of avoiding overly simplistic narratives. Markets are driven by multiple forces simultaneously. Rarely does a single factor explain everything. As technology advances, analysts now have access to unprecedented amounts of data. Financial professionals monitor information from stock exchanges, bond markets, currency markets, commodity markets, and real estate sectors around the world. By analyzing these data streams collectively, researchers attempt to identify patterns that may indicate future developments. The goal is not to predict the future with certainty. No model can eliminate uncertainty. Instead, analysts seek to improve their understanding of probabilities and risks. Successful investing often involves managing uncertainty rather than attempting to eliminate it entirely. This distinction is crucial. Economic forecasting is not about possessing perfect knowledge. It is about recognizing trends, evaluating evidence, and adapting as new information emerges. The future remains inherently unpredictable because human behavior, policy decisions, technological breakthroughs, and geopolitical events continuously reshape outcomes. Nevertheless, studying historical patterns remains valuable because certain dynamics tend to repeat. Human psychology has not changed dramatically over centuries. Fear and optimism continue influencing financial decisions. Confidence and uncertainty still drive investment behavior. Booms and corrections remain recurring features of economic life. By understanding these recurring themes, investors and observers can gain deeper insight into how financial systems function. Perhaps most important lesson is that major transitions rarely occur overnight. Significant economic shifts often develop gradually before becoming widely recognized. Debt accumulates over years. Investment trends evolve over time. Confidence changes incrementally. Capital flows respond step by step. Then, at certain moments, these gradual developments become visible to everyone. What appears sudden is often the result of forces that have been building beneath the surface for an extended period. This perspective encourages patience and long-term thinking, rather than reacting emotionally to every headline. Thoughtful observers focus on broader trends. They examine structural changes, monitor capital flows, evaluate economic fundamentals, and consider historical context. Doing so provides a more balanced understanding of financial developments. Today's global economy faces numerous opportunities and challenges. Technological innovation continues transforming industries. Demographic shifts are reshaping labor markets. Governments are navigating complex fiscal realities. Investors are adapting to changing interest rate environments. At the same time, global financial systems remain deeply interconnected. Not be stored or manufactured. It develops gradually through consistent performance, responsible decision-making, and trust in institutions. Once confidence begins to weaken, its effects can spread quickly throughout the economy. Financial markets are especially sensitive to changes in confidence because they focus on the future rather than the present. Investors are constantly asking what comes next. Will economic growth continue? Will inflation remain under control? Will governments manage their finances responsibly? The answers to these questions influence decisions long before official data reflects any changes. This is why capital often moves before major headlines appear. Investors who become concerned about future risks may begin shifting money toward assets they consider safer. These movements can affect stock markets, bond yields, currencies, and commodities. In many cases, changes in confidence appear before visible changes in economic conditions. Government debt provides a good example. Large debt levels do not automatically create problems, but they increase the importance of maintaining investor trust. As long as investors believe obligations will be honored and economic conditions remain stable, financing can continue smoothly. If confidence weakens, borrowing costs may rise, creating additional pressure on public finances. Confidence also plays a major role in currency markets. A currency derives strength not only from economic output, but also from trust in the institutions behind it. Investors prefer currencies issued by countries with stable financial systems, predictable policies, and strong economic foundations. When confidence increases, demand for a currency often rises. When confidence declines, capital may seek alternatives. Perhaps the most remarkable aspect of confidence is that it influences nearly every financial decision without appearing directly in economic statistics. It affects investment choices, lending activity, consumer behavior, and market valuations. Strong confidence can support growth even during challenging periods, while weak confidence can slow economic activity even when underlying conditions appear relatively healthy. In the end, confidence acts as the invisible engine of the financial system. Markets, banks, governments, businesses, and consumers all rely on it. Numbers matter, policies matter, and economic data matters, but confidence is what connects them all. Without it, even the strongest financial structures can face challenges. With it, economies often prove far more resilient than many people expect. Thank you for watching. If you found this analysis valuable, consider subscribing to the channel for more in-depth discussions on global markets, economic trends, and the forces shaping the future of finance. We appreciate your support, and we look forward to seeing you in the next video.